Hi guys, and today we'll talk about trading and what is trading and how it works. What is trading? Trading is a buying and selling of financial instrument in order to make a profit. This instrument range from a variety to assets that assign a financial value that goes up and down, and you can trade on the direction they take. You may have heard about stocks, shares, and funds, but there are thousands of financial markets you can trade, and the variety of products you can use to trade them. You can get exposure to markets as diverse as the S&P 500, the FTSE 100, global currencies like the US dollar or Japanese yen, or even commodities like lean hog or cattle. To get started, you'd need to create an account on the platform that offers these markets. Your online trading platform has a variety of financial markets that enabled you to speculate whether the price of an asset will rise or fall. Plus, we have complied a trading for beginners guide to assist you in getting familiar with the different markets. What assets and markets can you trade? There are more than 17,000 financial assets and markets that you can trade with us. These include shares, includes forex, ETFs, bonds, commodities, interest rates, IPOs, DAMs. Whatever instrument you trade, the intended outcome is always the same. To make a profit, if you buy an instrument for less than you sell it for, you'll make a profit. By if you sell it for less, you'll make a loss. It's important to know that trading is inherently risky, and you could lose more than you expected if you don't take the appropriate risk management steps. Trading vs investing. The difference between trading and investing lies in the meaning of making a profit and whether you take ownership in the asset. Traders make profit from buying low and selling high, going long, and selling high and buying low, going short. Usually over the short or medium term. Investors aim to buy shares at the price and take outright ownership of the stock. They make profit from holding the stock and selling it at the higher premium. Their hope is that the share price changes over the long term and they can profit from the movement. Investors could also earn income in the form of dividends if the company grants them. Plus, they'll have shareholder voting rights. Who trades and who invests? Traders, as opposite to investors, are those who prefer to make use or leverage and derivatives to go long or short or a range of markets. Individuals called retail traders, institutions and governments trade. They participate in financial markets by buying and selling assets with the aim of making a profit. In 2021, retail traders accounted for 23% of all US equity trading, double the amount of 2019, buying more than 1.9 billion in stocks. This number soared after coronavirus related volatility hit the market and stock prices fluctuated and an unprecedented rate. Some financial traders stick on a particular instrument or asset class, while others have more diverse portfolios. Governments and institutions can adapt at a much faster pace as they often have departments that focus on trading different sectors and industries. Institutions remain the biggest participant in the market with 77% of the traders attributes to them. For individuals to invest on the stock exchange, they must do through a stockbroker that will execute the order. They'll do their research before placing a trade, read charts, study trends, and the broker will act on their behalf. They trade from their own private accounts which they fund and bear the full risk of losing their capital. Institutions that trade include commercial banks, hedge funds, and corporations that have an influence on the liquidity and volatility of stocks in the market. This is because they typically engage in block trades, which company comprises of buying or selling at least 10,000 shares of more at the time. These entities stands to profit from supply and demand of goods or products, political instability, the availability to currency, and many other factors. How does trading works? When you trade, you profit in the market price of your positions moves in the right direction and you lose money in the price of your position moves in the wrong direction. The basic premise to remember is supply and demand. When there are more buyers than sellers in the market, demand is greater and the price goes up. If there are more sellers than buyers in the market, demand is reduced and the price goes down. Getting exposure to a set can only be carried out often the counter, OTC, or directly on an exchange. Trading OTC involves two parties, trader and broker, reaching an agreement on the price to buy and sell an asset, whereas an exchange is highly organized marketplace where you can trade a specific type of instrument directly. For example, you can trade US shares on the London Stock Exchange, LCE, as you'll come to realize most retail traders in the UK trade OTC using derivatives like spread bets and TFDs because the shares are more accessible that those listed on a centralized exchange.